Welcome to the Wealthsteading Podcast. This is episode 501. Today is December 3rd, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, as we come into the final month of the year, it looks like the panic that we've seen over the last, 6 weeks or so has subsided. That's what I want to talk to you about in this episode. I want to give you a real quick market review, give you my take on what's happened with the slight pullback we have and where we're likely headed through the end of the year. Now, first off, over these last 6 weeks or so, when the media narrative was extremely negative and there were two main points that they were hammering on. One was that we were in an AI bubble, and the other big issue that they just couldn't stop talking about was, whether or not the Federal Reserve would cut rates at their upcoming FOMC meeting, which is next week, and how likely rate cuts would be into the future. Well, the media likes to perpetrate fear, and I'm going to end today's episode with some comments about how you can overcome fear, because the two factors that have the most negative impact on investors is fear and greed. If you can get a handle on those two items, then you're more than 80% of the way to being a better investor. But I think what we've seen over this, most recent sell-off, and I say that charitably, because if you blinked, you would have missed it. And there was only a couple days in there when you could, even try and get in at the lows. The lows weren't that low at all. In spite of all the negative media comments, if you look beyond the headlines, you'll see how strong and resilient this economy really is. A statement just came out this week from the OECD. That's the international organization that's for economic and co-development. And their statement was, pretty telling. It said specifically, and I quote, "There was surprising durability in the U.S. economy." Well, that is the reoccurring theme, and hence my cynical optimism that we're not in an AI bubble, and what we're experiencing right now is much different from what we saw during the dot-com bubble. Specifically, companies are profitable and making money, and they're making it at much higher growth rates than in the past. Look at third quarter GDP. It, again, beat expectations, beat even my expectations. It was up over 13%. That means that every quarter of S&P 500 profits so far this year has been in the double digits, and I think it's highly likely that the fourth quarter is going to end that way as well. And likewise, look at GDP. It continues to perform way above expectations in the range of a 3% growth rate. That's pretty substantial when you consider all the fear and panic we've had, everything from tariffs were going to destroy the global economy to even most recently, the big fanfare over the government shutdown. I mean, it continues to amaze me that the media makes such a big deal about not having something like, the jobs report or the official GDP number. Just step back and think about this. Whether the federal government or any other government agency is putting out data, how much can you really trust it? Whether it's the red team or the blue team, to me, it's all suspect. And so you're dealing with shaky data to begin with. And even beyond that, are you telling me that if the federal government doesn't put out a report about the growth of the economy or the current jobs rate, do you really think that the Federal Reserve doesn't have their own database and their own access to all, literally all the transactions that take place in this country, as well as imports and exports? Or do you think that the chief investment officer at Walmart doesn't have instantaneous data of what their sales are and how they compare to previous months and quarters, and that they can use that to extrapolate and build models that are far superior from anything the government's going to release? Are you telling me that JP Morgan Chase or Google or Amazon or Netflix or any of these major multinational corporations, that any of them don't have enough of their own data that's as good or better than anything the government's going to put out? But yet we had to endure the longest shutdown in history and what that was going to do to the economy and how economic decisions couldn't be made because jobs reports and GDP numbers would be either not released at all or would come out late. And again, look at the scoreboard. Third quarter S&P 500 profits up more than 13%, and as I record this, the S&P 500 as an index has recouped almost all of the gains that we lost during this most recent sell-off. It's only about 75 basis points, right, less than 1% from its all-time record high. And how many of you missed the dip and didn't use this as an opportunity to at least get some more money back into the market? I bet a lot of you did, based on comments that I've received over the previous couple episodes that I've done, where I've talked about the AI bubble not being what it was with the dot-com bubble. In fact, the more people talk about an AI bubble, the less likely it is to happen. Sure, there's a business cycle associated with the current build-out of artificial intelligence. There's no way we can keep up at this rate forever, and we're already starting to see big divergence within not only sectors of the S&P 500 and the economy, but also within the big leadership names. You know, the Magnificent Seven haven't been magnificent for most of this year. But that doesn't mean we're in a bubble or a major crisis. It simply means that, as always, markets adjust and people adapt. NVIDIA stock can't keep going to the moon and grow at 30 or more % annual rates of return forever. Okay, it's just part of the business cycle like any cycle. But to say that we're in an AI sell-off or an AI meltdown simply because, you know, the price of a stock like NVIDIA has pulled back this year is absurd. I mean, take a look at NVIDIA. And this is the healthy aspect of what you're seeing within the economy. NVIDIA, which has been a darling for the last, 3 years, its performance right now in the S&P 500, it's ranked, as I record this, number 79. So yes, it's pulled back. But you know what? It's still better than 420 other stocks in the S&P 500. And even though it's had a much worse performance and has pulled back this year compared to what it's done over the previous couple years, you know, its performance is still stellar. Year to date, it's up 34%. I mean, you call that a meltdown? You call that a bubble that's sold off or about to burst? I don't think so. I don't think so because this market is broadening out. It's not all about 5 or 6 or a dozen stocks. You know, there are 78 stocks that are performing better than NVIDIA. And if you look at the Mag 7, most of them are performing below that 79 level of NVIDIA. And what I find funny about the Mag 7 this year is that, you know, you go back exactly 1 year ago today, and people had written off Alphabet, Google. They said it's irrelevant. It missed the boat on artificial intelligence. It's online advertising, and Chrome were going to suffer. The search results through Chrome were going to suffer in terms of advertising dollars. It was late getting Gemini out, and the Gemini just didn't compare to ChatGPT or even the Chinese knockoff version, called DeepSeek. And that was about a year ago. You can check my blog post for November, I think sometime mid-November. I actually doubled down on my position in Google stock or in Alphabet because I thought the price had gotten way too low. Whether you're talking about online advertising or social media through things like YouTube and streaming, or whether you're talking about driverless cars with Waymo, these guys are way ahead of the curve. And that's proved right over this past year. Because of the Mag 7, Google being about the worst last year, it's currently performing the best this year. It's up almost 70% year to date. And if you go back to when I bought back into it in November of last year, sometime mid-November, it's up, I'd say, over 90% since then. And again, this is the way the negativity works. The media drums up a story about some underperformance. There's a herd mentality. Everybody sells off on this stock. There's continuous bad news about it. And then lo and behold, when earnings come out, the company's doing just fine, and everybody rushes in to buy it again. Specifically, what the media does, and my theory on Wall Street, is that they spook you out of owning the best stocks when they're putting in record highs. They get everybody to sell them, and then they come back in and buy the dip at a lower price. That's what I think has happened with the S&P 500 and the other indices over the past 6 weeks. Look at the S&P 500. It literally closed only 1 day below its 100-day moving average. That's a 100-day moving average. A lot of people were saying they weren't going to buy in until it dropped down to the 200-day moving average. Well, that was around 61, 6,200. It never even got close to that. I don't think it ever even got below 6,500. Over these devastating weeks with the government shutdown and all the negativity, the S&P 500 only dropped a little more than 5%. It spent one closing session under that 100-day moving average, and then it bounced up, and within 2.5 days it was above its 50-day moving average. Right now it's well above that 50-day moving average, and in fact its short-term exponential moving average is moving up and to the right. Yes, I'm saying that what we saw the last month or so was simply a manufactured sell-off, a creation of fear to get the price down so that the hedge funds and the other fat cats on Wall Street could buy into the dip so that they can get a position to improve their end-of-year positions. And not only are things broadening out and improving within the S&P 500 and beyond the dozen or so leadership stocks, we're also seeing, especially over this last couple weeks, major improvements in small and mid-cap stocks. And in fact, the mid-cap 400s dropped all the way down to their 200-day moving average, as almost did the small-cap 600s. And you know what? Just like the S&P 500, they're back almost to their 52-week highs, and that performance is supported by their earnings, because not only are we seeing earnings hold up within the Mag 7 and within the hyperscalers and within the AI-related stocks, but we're seeing a noticeable improvement in the profitability of those small and medium cap stocks, and especially in those other 493 stocks in the S&P 500. This is really the first time in about 3 years where we've really seen not only solid growth in this quarter, but moving out over the next 12 months, the non-Magnificent Seven have about their highest growth rate that, again, I think we've seen in at least 3 or more years. And that's because what's happening is that artificial intelligence is not only benefiting those big hyperscalers, but individual businesses are adopting it and putting it to work, and it's increasing their productivity. And while I remain so cynically optimistic for next year, is I think that we're going to see not only this AI benefit of productivity kicking in even harder in 2026, I think we're also going to see the benefit of the deregulation that took place this year and contributing to profitability next year. Another huge factor for 2026 that this would be funny if it wasn't so pathetic, but you saw over these past 4 to 6 weeks the huge negative stories that the Federal Reserve wasn't going to cut interest rates, or they weren't going to cut them as much. But all that is so irrelevant talk, because as the end of February, all 12 of the current regional presidents, their terms are up. Now, some of them may be back in place, but you can be pretty sure that most of them won't be. And likewise, the chairman, Jay Powell, his term's up in May, so he'll be gone by then, if not even sooner. What I'm saying here is that the entire composition of the current Federal Reserve is going to be changing. It's only the Board of Governors that have terms that will extend past next year, and a lot of them are getting replaced as well. So all the hand-wringing, all the worrying, all the Monday morning quarterbacking going on about whether the Fed will cut rates at the next FOMC meeting is totally irrelevant, because by spring of next year, there's going to be a whole different agenda with the Federal Reserve. And I'm not saying whether that's good or bad. I'm just saying it's irrelevant to worry about it now and for the panic to driven down the stock market like we've seen over the past couple weeks. So I haven't been at all worried about this sell-off. In fact, from a technical standpoint, it doesn't even count as a correction. I'm glad that I didn't wait for it to drop down to, below the 100-day moving average, because I would have totally missed the dip. I did jump in, taking almost all the cash reserves I had and putting them into different areas of the stock market. You can see that at my blog posts over at investablewealth.com. And while I can't predict the future, and I don't know if the market may not drop tomorrow, the bottom line is that the performance over this so-called sell-off has been extremely orderly, so much so that like I said, it's almost synchronous that it dropped down right to that 100-day moving average and then quickly rebounded. That's a classic example of the fat cats on Wall Street scaring everybody so that they can come in and buy the dip at a predetermined moving average. And this is where I want to end the message today. Fear and greed, that's what drives the market. I know a lot of you are sitting out there, sitting on cash, and you missed this buying opportunity. And you're probably going to wait until the next one and you likely miss that as well. Listen, you're never going to buy at the absolute bottom. But if you believe in the strength and resilience and the growth of the overall economy, then it doesn't matter if you buy in somewhere in the middle. Maybe you buy in just below the 50-day moving average. Maybe it's a little bit above. Maybe you get in early on a pullback to a short-term exponential moving average. But to win the game, you have to be in the game. And you have to overcome that negativity, and I know it's hard because you're programmed through your DNA to recognize vulnerabilities, to recognize your fear, and let the instincts take over of fight or flight. But you are specifically programmed to favor negative information over positive information. As humans, we have a negative bias built into our DNA. Think of it this way. Let's say you're a caveman or Neanderthal, whatever your ancestors were, and you see some new technology come along, a different way to form a spearhead or a different method to make a fire, right? That's their technology of the day. If you ignore that, if you miss it, it's probably not going to be life-threatening. And you'll pick it up next month, next year, whenever. That's your instinct for identifying opportunities. It's hit or miss. The status quo is just fine. But when it comes to fear, if your ancestors didn't react to an emergency, because a tiger was attacking the tribe, or because of some other threat or predator, if you didn't react quickly to that negative impulse, right, to have a negative bias, if you didn't react to that, it was life-threatening. It was existential. You likely didn't survive to live through the next crisis. And so those people didn't have kids. They didn't have posterity. And so all of us that have survived, our DNA is geared to look for the negative, to look for bad things to happen, and then to react quickly and accordingly. But if you let that happen to you with your investments, you're going to miss out. I don't have to tell you that. You're already missing out. And those of you that aren't, well, hey, I'm preaching to the choir. Well, I'll end it here for today. So far, I remain cynically optimistic. I do think we're headed for a Santa Claus rally to end the year. We'll see what happens. Until then, as always, this is John Pugliano wishing you the very best returns.